Welcome to the Apella Capital Mid-Year Market Update. My name is Jason Gentile, Director of Financial Planning at Apella Capital, and joining me today is Phil McDonald. He is the Director of Fixed Income and Alternatives at Symmetry Partners, our sister firm. Phil, thanks a lot for joining us today.
Glad to be here, Jason. Thank you.
The purpose of these videos is to inform our clients, and we've been fortunate enough to gain a bunch of new clients over the past 6 months. So welcome if this is your first time watching one of these videos. The purpose of the video is to just keep everybody up to date with what's going on in the world of finance, and how it impacts our portfolios. So with that being said, it's probably a good idea maybe if we just set the table for those who are a little bit new to Apella Capital and Symmetry Partners. Phil, just give us a quick overview of the Symmetry portfolio and the investment philosophy behind it.
Sure. Glad to do that. So broadly speaking, on the equity side of things, we are very diversified globally. So we're strategically allocated to U.S. equities, international developed equities, emerging market equities, all the time. We're not making changes based on headlines or events in the marketplace or trying to tactically time things. Furthermore, on the equity side, we target the capture of factors, essentially. You might have heard of the term multi-factor investing. And a simple example of that is value versus growth. So over the long term, both experience and academic research indicates that value outperforms growth. So we'll target certain factors, value being one of them, small cap premium, momentum, a few others, in the effort to outperform a simple market cap weighted index. On the fixed income side, relatively similar. We're broadly diversified globally, focused on investment grade fixed income securities. And depending on the investor's risk tolerance, we will take a little bit more, a little bit less exposure to maturity premia and credit premia and illiquidity premia on that side of the portfolio. So I think that's a quick overview for the new investors.
So yeah, I mean, I guess to kind of sum that up, really, then it would be, that we're not stock pickers, we're not market timers, we don't think we're smarter than the overall market. We use financial science and kind of rely on academia more than anything to help influence and guide us in terms of how we build our portfolios.
Absolutely, it's very fair to say that. We look to academia. We'll do a lot of quantitative work on the asset allocation decision side of things, but what we're really trying to capture are the systematic sources of return in the market, and there's different ways to carve those up and analyze them and look at them, and that's really kind of what we're doing.
Okay, so being that we are, I guess, a globally diversified portfolio, and we go far beyond just the United States in our investment strategy, why don't we start to look at geographically some of the things that have gone on in the world, and geographically how we've performed. So why don't we start here in the U.S.?
Sure, yeah. No, that's a great idea, Jason. And just before I get going on that, I want to treat the question that wasn't asked. Very often, we'll speak to people who are focused on the performance of the S&P 500 or the Dow Jones Industrial Index, and those are U.S. focused large cap indices, so not great benchmarks for our portfolio or way of investing. That said, in the U.S., equities continue to outperform, so it's been a strong geography, relatively speaking, for some time, and it continued to do reasonably well. The developed international markets, they're a little bit more of a mixed bag. Some months are positive, some months are negative. Year to date through 6/30/2016, they're down a little bit. The U.S. market is up a few percentage points. And on the emerging front, this is actually where I think the more interesting story is in equities. Emerging has had a rough go of it for the last year or so. And through the second quarter of 2016, emerging is the strongest performing region in terms of equity. And specifically, you can look to the MSCI Emerging Markets Index to kind of see that performance. Also, specific to emerging markets, it's interesting to look at our periodic table of asset class returns. Emerging value 3-4 quarters ago was the lowest performer on a relative basis. And if you looked at the first quarter of 2016, it recovered to nearly the top of the rung, top of the ladder, comparing performance across multiple asset classes. So that's an interesting lesson, which I think you and I are very familiar with, but it bears mentioning again. Looking to recent relative performance isn't a great way to pick and choose asset classes. You asked about events also. So two events through the second quarter kind of jump to mind for me. One is a really tough January globally in equity markets. We saw many broad indices down 6-7%. I believe the All Country World Index was down 6% in January. And just at the end of the first quarter in March, a lot of indices had recovered. So the MSCI All Country World Index was up 7.5% in March. So it made for a very interesting first quarter. And again, kind of short-term events that are probably better ignored than acted upon. And secondly, big news at the end of June was the UK referendum to exit the EU, commonly referred to as the Brexit. I recall that vote was on a Thursday. And leading up to the referendum, both sides, stay, leave, were roughly polling probably equally, roughly 50-50. Late Thursday night, it was clear they voted to exit the EU. So Friday and Monday were both very tough days in the market. Equity indices and currencies were down. There's a lot of volatility and fear, it appeared. Now looking at the markets, again, it's a very short-term perspective to take relative to most investors' horizons. But now we're about 20 trading days away from that. The All Country World Index, the FTSE 100, a large cap equity index in the UK, they're up to levels higher than pre-referendum. So another very important lesson, excuse me, to kind of look through some of these short-term events in investing.
It's funny you say that, and I was thinking about this the other day, actually, based on one of the conversations we were having. If we told investors in December that the equity markets would get off to, especially here in the U.S., the worst start to any trading year since the Great Depression, you'd have continued acts of global terrorism, and that Britain would vote to leave the EU, people probably would not have invested, right? You would have pulled your money out of the markets. Yet here we are today with global equity markets in positive territory, portfolios up in positive territory. So, it just goes back to what we were originally talking about, and us not being market timers, thinking that we're smarter than the market, because that clearly would not have been the case. Another thing that we talk about regularly on these updates, and it goes hand in hand with how we manage most of the portfolios, is fixed income. Right on the other side of the equities, you have the bonds for most investors, and we've been talking about interest rates and what they're going to do, and right now, why don't you catch us up to date with kind of how the Fed views interest rates, future movements, and what bonds have done in the near term?
Sure. Yeah, you're not kidding. We've been hearing questions about a so-called bond bubble for probably more than 5 years now.
Right.
And it's amazing. I'm actually impressed with some of the education that has happened, and investors are kind of aware of duration and taking interest rate risk in their fixed income portfolios. But in the U.S., it pretty much starts with the FOMC, part of the Fed, in deciding short-term interest rates. And they're a data-driven organization. They look at unemployment, inflation, and growth, economic growth, and make their decision to try to kind of maintain some stability, kind of hit the target in between all those moving lines. And there's just been, while the U.S. economy has seemed to strengthen based on some of those metrics, there have been a lot of global events, volatility in the markets, other major currency blocks. So the European Central Bank setting kind of policy rates on the euro, in the yen block, the risk-free rates on yen are pretty low. So it seems now. Nobody knows for sure, but it seems now that the FOMC is likely not going to be very aggressive raising rates this year. Who knows what will happen? We also have a presidential election, and
I hadn't heard.
well, the Fed is supposed to be an independent body, so you might hear that changing rates that has an impact on economic activity too close to an election is not a smart idea. So they might certainly avoid the early November timeframe in raising rates. But that said, you can look to the market for expectations. The market doesn't expect rates to go up in the short term. And quick refresher for fixed income securities: when yields go up, prices go down. The yields haven't necessarily been going up. In a lot of cases, they've been going the other way. Yeah. So bonds have actually been performing pretty well. I alluded to globally diversified investment grade bonds earlier. One index you can look to, the Barclays Global Aggregate Index, is up nearly 9% through the second quarter. So folks who have an equity and fixed income kind of balanced allocation in their portfolio, they've seen the benefit of investment grade fixed income doing pretty well. In fact, a return higher than the emerging markets equities through the second quarter. So
you touched on something in that comment on fixed income. We do have an election coming up, and one of the common questions we hear, no matter what your political affiliation, there's worries about whoever gets into the White House. So give us your thoughts and Symmetry's thoughts on how we view events like that, regardless of who's the victor.
Sure. It's hard to ignore the headlines and all the hoopla, and we're actually in the midst of the two parties conventions now. We're in between. The DNC starts today, I believe. Essentially, markets have done well. Financial markets have done well and done poorly with Democrats, with Republicans in office. So we definitely don't see a direct causal link between party and performance. There's a lot more to it there. In fact, we would probably chalk it up more to the short-term event, the headline that you should probably not pay too much attention to. Granted, presidential terms are 4 years, Senate terms are 6 years. We can also point to the fact that we have 3 co-equal branches of government. So there is Congress and the Supreme Court, who theoretically are going to be there along with whoever is president.
So, I mean, I guess that kind of really, once again, takes us back to the beginning. These, if you could almost look at it in the same way we should have looked at Brexit, or most investors should have looked at Brexit. This was a big news story. It's a news cycle where we tend to focus on negative things. But this is and will end up being another one of those things that investors, for the most part, should ignore. I say to people quite often, you'll wake up every day for the rest of your life and there'll always be a reason not to invest.
Sure.
That is probably going to be the one that dominates headlines here, at least over the next week or so, while, as you pointed out, the DNC is going on. But we've got quite the long election cycle in this country. So,
sure. Yeah.
Taking it back, I guess, to an earlier point, again, you referenced the periodic table of asset classes, and we were looking earlier at the full version of it with 10 or 12 years of data up there, best performing ones, and it made me think about how hard it is to predict asset class movements. The U.S. having done very well in recent years, but it doesn't take too long of a history lesson to get to a point where the U.S. was not the best performer, where it was emerging markets and international markets. And, we refer to that as the lost decade around here.
Yep.
So tell us a little bit about kind of the lost decade and what happened in that period, and if this might be something similar on the kind of the opposite end of the spectrum that we've seen in recent years here.
Yeah, for sure. I mean, looking at that periodic table you referred to, I believe from memory, the S&P 500 is somewhere near the top of that ranking for 2-3 years. That's something consistently you might not expect to keep going.
Right.
The lost decade was one in which you looked at the S&P 500 or other well-known U.S. equity indices, and they drastically underperformed a globally diversified portfolio that had, allocation to value and emerging markets and international developed markets. So I think you make a good point that it's actually a pretty well-known aspect of behavioral finance, recency bias. So whatever did well recently, we will kind of project that ourselves into the future as something more likely to happen. And it's usually biased, and it's usually completely kind of lacking the fact and the knowledge of what really will happen, and nobody really knows what will happen in the near future. That said, I think from a factor perspective, and again, value versus growth is probably the easiest example you can think about with our portfolios overweighting value. Value had a tough go of it for the last few years.
Yeah.
And through the second quarter year to date, it's experienced a drastic recovery, which again is an important history lesson in, things can reverse quickly. You can't take recent performance and project it into the future. And again, based on the academic research and historical performance, our portfolios are going to remain kind of allocated to try to capture those different factor premia.
So, just kind of to sum all of this up, if we look over the long haul, right? We've seen plenty of periods where the U.S. outperforms and where the U.S. underperforms. We've seen plenty of periods where growth outperforms and value outperforms, and small versus large, and plenty of other factors that we target in our portfolios. The idea here, I guess, really is that we don't know in any given year what the best factor is going to be, what the best asset class, what the best country, what the best stock, mutual fund, anything is. So we have a constant and consistent allocation to these, across all of our portfolios.
That is correct. We will overweight the value factor versus the growth factor because we believe in it longer term, but that's 100% correct. We're essentially invested across the board all the time, with a little bit of a tilt to what we think are higher returning kind of asset classes.
Okay. Well, I mean, I think to this point, we've done a good job summing that up. And unless you've got any market predictions about what's going to go on over there.
Oh yeah, that's what I really want to focus on today.
Well, I do want to thank you for helping me out here today, taking us through the Symmetry portfolio, and in a short term and a near term and a very long term history lesson too, as we started to look back at some of the asset class and the factor returns. So thank you to all of you who viewed this video. Should you have any questions about what portfolio you're in, how these market factors impact your portfolio, how you're diversified, we'd be happy to answer any of those questions at any time. So please call us or email us at your convenience. We look forward to speaking with you often. So once again, Phil, thanks so much for joining us.
Thanks for having me.
We'll talk to you all again very soon. Thank you.